Well, Friday's market action was a real gut punch, wasn't it? A sudden, sharp sell-off that just erased weeks of gains and left a lot of us wondering what on earth happens now. So let's break down that Red Friday crush and get you positioned for the week ahead. All right, quick disclaimer before we get into the thick of it. This is my analysis, my opinion. It's for educational purposes. It is not financial advice. Every single investment carries risk, so please do your own homework. Friday was just brutal. The S&P 500 plunged almost 2.7%. I mean, it wiped out weeks of hard-earned gains in just a few hours. A move like that, it definitely catches everyone off guard. And at the same time, the VIX, what we call the market's fear gauge, absolutely exploded higher. It spiked nearly 32%. When you see a move like that, it's not just nervousness. It's a clear signal that real, genuine fear just flooded the market.
Okay, here's our game plan for today. First, we're going to look at what actually triggered that plunge. Then, we'll dive into the fear, the volatility, and the key technical levels that everybody is watching right now. We'll check out the sector battlegrounds, lay out both the bull case and the bear case, and then we'll wrap up with how some traders are using options to navigate all this chaos.
So what lit the fuse on Friday? Well, this wasn't random. That sell-off was a direct, knee-jerk reaction to a very sudden and very sharp escalation in the US-China trade war. It all started when China restricted some key industrial minerals. Then, Friday morning, the US retaliated with a massive 100% tariff on certain goods. But here's the kicker. They set a hard deadline of November 1st, and that deadline is what really spooked the market. It turned this simmering dispute into an immediate, very real threat to profits.
Now this is where it gets really critical. You see, the news lit the match, but it was the market's own mechanics that poured gasoline on the fire. The first drop was the reaction, sure, but the acceleration of that drop, that came from the internal plumbing of the market itself.
The market flipped into what's known as negative gamma. Now put simply, this creates a really dangerous feedback loop. As prices fall, the dealers who sold insurance, put options, they are forced to sell stocks to hedge their own risk. And of course, that selling pushes the market even lower, which forces them to sell even more.
And this quote just says it perfectly. It's like an accelerator pedal for the sell-off. It becomes a self-reinforcing downward spiral, and it often doesn't stop until the market slams into a major technical floor, a price where the big money buyers are finally willing to step in and soak up all that selling.
So the big question is, where is that floor? Well, for the S&P 500, the line in the sand everyone is watching is 6,500. For the tech-heavy NASDAQ, looking at the QQQ, that critical level is 580. If we break below these levels with any real force, it could open the door to a much, much deeper slide.
But this trade war isn't a tide that just lowers all boats equally. Oh no, it is creating a battlefield with very clear winners and very clear losers across different parts of the market.
On one side, you've got the semiconductor sector, and it is getting hammered. These companies are right at the epicenter of this thing, and they're heavily reliant on those global supply chains. We've got key earnings from Taiwan Semi and ASML this week that are going to be absolutely critical. But on the other side, companies involved in rare earth and critical minerals are exploding higher. I'm talking names like MP Materials and Lithium Americas. They're surging because the market knows the US government will have to pour money into securing a domestic supply.
Now, despite all the fear, despite the ugly red candles on the chart, a really strong argument can be made that this is actually a buying opportunity. Let's take a look at the bull case. So the bull thesis is pretty straightforward. This is a geopolitical panic, not a fundamental breakdown. Bulls will point out that corporate earnings are still strong, and historically, VIX spikes this high, they often mark the point of maximum fear right before a major bounce. They'll also argue that today's market leaders are incredibly profitable, which provides a solid foundation, and ultimately, the bulls believe those key support levels we talked about are gonna hold.
The bears, of course, have a very different take. They don't see this as an opportunity. They see this as a warning shot, and that a lot more pain could be coming. Now, the bear case is rooted in history. They're drawing parallels to the 2018 trade war, which caused a really painful multi-month downturn. They're warning that if that 6,500 support level breaks, that negative gamma feedback loop is going to kick in hard and accelerate the selling. You add in other risks, like a potential government shutdown, and the fact that retail investors just piled in, which is often a contrarian red flag, and bears see the perfect recipe for a much deeper correction.
So with this intense tug of war going on between the bulls and the bears, how do active investors even navigate this?
Well, many of them turn to the options market to manage their risk and express a very specific point of view.
Options can be used in a few key ways in an environment like this. You can use them to protect your existing portfolio. You can use them to bet on a specific direction, or you can use them to actually generate income from the high level of fear itself.
A pretty popular strategy for this kind of market is called the wheel. The basic idea is you get paid to agree to buy a stock you already like, but at a lower price. You do that by selling a put option, and you collect that cash, that premium. Now, if the stock falls and you do have to buy the shares, you then turn around and start selling call options against them, generating even more income. It's a systematic way to create cash flow, but just be aware you could end up owning a stock that keeps falling.
So, to simplify it all, there are really three main approaches. If you're bearish, you can buy puts. Think of it like portfolio insurance. If you're bullish, you can buy calls to play for a bounce with a defined limited risk. And if you're kind of neutral, you can sell options using strategies like the wheel to collect those high premiums that all this fear creates in the market.
So the bottom line coming into this week is really simple. Right now, all eyes are on that 6,500 level on the S&P 500. Whether the bulls defend it or the bears finally break it, that's likely going to determine the market's direction for the rest of the month.
And that leaves us with the ultimate question every single investor has to answer for themselves right now. Was Friday a gift, a chance to buy great companies at a discount, or was it the last warning bell before the real storm hits?
We'll be watching that 6,500 level like a hawk. It's the key battleground for this week. Thanks for tuning in, trade smart, and stay informed.